How do health savings account HSAs benefit taxes? This is my today's topic, which I will explain with an example. I request lawyers, tax preparers, taxpayers, entrepreneurs, students, economists, and the most important, politicians who create laws to subscribe to my channel to receive the most up-to-date and accurate tax information to enhance their knowledge. This is Nashimar, the CEO of InfoTaxSquare.com. We are a team of CPAs and EAs. Let me share with you some characteristics of HSAs plan before I explain it with an example. The purpose of a health savings account HSA is to provide tax advantage savings to individuals for medical expenses. An HSA is a tax-exempt account that a taxpayer establishes with a U.S. financial institution. The objective of an HSA is to save money before tax and use it exclusively for medical expenses in future. The amount that can be contributed to an HSA is influenced by the nature of the taxpayer's coverage and his or her age. In 2024, a taxpayer or their employer is eligible to contribute up to $4,150 for self-only coverage or $8,300 for family coverage. For those age 55 or older at the end of the tax year, an additional $1,000 catch-up contribution is added regardless of the coverage plan. Contribution made until April 2025 may be included in HSA contributions for 2024. FSAs and HSAs have tax savings potential that make them more advantageous than paying cash. Contributions to FSAs and HSAs are tax deductible, which means that they reduce the taxpayer's taxable income. Taxpayer will save money in the long run due to this. Upon withdrawal of funds for qualified purposes, they are tax-free. I'm going to explain with an example how much an individual or a taxpayer can contribute in HSA plan or health savings plan. Jennifer, who is 58 years old, so since she's over 55 years old, make the decision to open an HSA in January 2024. What is the amount Jennifer can contribute to the HSA for 2024 if she has self-only coverage? So her regular contribution is $4,150 plus, since she is over 55, so she can catch up additional $1,000. So her maximum contribution for the year 2024 is $5,150. I'm going to present here an example of two taxpayers, one who was covered with the HSA plan, whereas the other one was not covered with the HSA plan. And we have to see the tax benefit. The person who was covered with the HSA plan we also have to understand the difference between before tax cost and after tax cost. What is before tax cost? Before tax cost is a gross income before any taxes are applied. It is a raw expense you need to cover. What is after tax cost? After tax cost is the net amount you actually pay after taxes have been deducted. We have an example here. I'm going to share with you an example or a case study. William, who participated in HSA fund and contributed $2,000. When he received his medical bill of $2,000, since he was covered with the HSA plan, he did not pay anything out of his pocket. Whereas Martin, who was not covered with the HSA plan, he also received a bill of $2,000 in medical expenses. Since he was not covered, in order to pay his bill of $2,000, he has to earn $2,632. So since he was not covered, so he is going to pay out of pocket $632. So Martin has to earn $2,632 to cover his $2,000 medical expenses after taxes. This extra $632 is the tax he pays on the income required to cover the expense. Thus, Martin after tax cost is $632 higher than William. Thank you and God bless you.